Okay. All right. Good evening, and welcome to our management information class. We are going to be taking this topic, costing method, process cost. Okay, so process costing is our focus for today. What are we going to learn about in process costing? We are going to explain what process costing is. We're going to look at the following situations. We're going to see something called normal loss, abnormal gain, and preparing costing with closing work in progress. Okay, that is what we'll be taking for part one. Then part two, you would see opening work in progress, where you will now have weighted average cost method, then the FIFO method, then work in progress and losses. Then you will see process costing, joint products, and byproducts. So for the next two classes, we'll be taking part one and part two. So today, we are concentrating on part one. All right, what is process costing? Okay, when you hear the word process, what does it mean? This has to do with something that goes step by step. So when you say you are processing something, it means it goes to one first chamber or the first step. After that, it moves to the next step or the next process or the next stage and all that. So you are processing it stage by stage. So process costing provides a system of costing where any or all of these characteristics occur. Now look at these characteristics of process costing. Output is continually produced from the manufacturing process and is normally measured in total quantities such as tons or liters, or in a very large quantities of small units, such as the number of cans or tins. So let me give you an example. If you are working in a tomato company where they make tin tomatoes, so you see tins, the output is continually being produced. The things are being produced continually. Or maybe you are producing cans. That's another example. Another characteristic, in the production process, materials might be added in full at the start of the process or might be added gradually throughout the process. Okay, so what it means is that if we are to make, let's say, bread, all the ingredients, the materials for bread would have been added at the start of the process. That is, in process one, all the materials would have been 100% complete. But if it is not 100% complete, at least it would have been like 90% complete. So as you go gradually in the process, you are adding materials. But most times, it is 100% complete. The materials are processed to produce the final output. In a process costing system, it is usual to distinguish between direct material and conversion cost. Now, when we say conversion cost, we mean what are the costs to convert the direct material to finished goods. So we have labor. There will be some labor put to convert. There is some overheads that will also assist in converting of direct material to final output. So we are going to be seeing all of this in just 2 lines. First line, direct material. This is because the quantities of direct material is what we are trying to track or trying to account for in the final product. Then every other cost apart from material is called conversion cost. Now, another characteristics of process costing is that there might be losses in the process due to evaporation or chemical reaction, and the quantity of output might therefore be less than the quantity of the input material. Now, let's say you're making cake or bread, and the input material is flour. You have put them um, in their tins or in the cans that is housing them, waiting for them to rise so that you can put them in the oven. Now you've counted like 100 loaves of bread you want to make. So when you are putting it into the oven, you are expected to harvest 100. But due to some process loss in the process, you might get 99. Okay, let's say you are trying to heat a soup, or let's say a soup, and the soup is 2 liters. At the end, because of evaporation, you might not get complete 2 liters. That's what we mean. When there is a continuous production process, it is difficult to measure the quantity of work in progress or incomplete production at the end of a financial period. So the process costing involves a method of measuring and costing incomplete work in progress. So it means that during the period review, it is impossible to measure the quantity of work in progress that you have at the end of the period. Let's say today is our accounting year end and we are making bread. I will find out that the bread, some parts have not been fully completed. That's work in progress. We cannot measure the quantity of work in progress. Let's say, for example, you cannot measure correctly what is the total percentage or total quantity, yes, in percentage of completion of materials or of conversion. But we must find a way to measure it and in some processes, more than one product might be the output from the same process. Let's say in crude oil, in crude, when you process crude further, you might get maybe 3 or 4 products. Diesel, petrol, resin, perhaps liquefied natural gas. So this is more than one product. There or byproducts. We are going to see how we can take care of that. In some process manufacturing system, there is a series of sequential processes. For example, in a manufacturing system, there might be 3 consecutive processes. 1, raw material are put into process 1 and they form inputs in process 1. When process 1 finishes its work, it gives out to process 2. So process 1 output becomes the input of process 2. And process 2, excuse me, excuse me, Okay, so in some processes, we have all this process 1, process 2, and process 3. So process 2 output becomes the final process that becomes the input of process 3, the final process. And when process 3 finishes, the output of process becomes the final output, the final product. So it means that it must go through all these processes. Situations where process costing might be appropriate. Examples where you can find process costing is chemical manufacture, manufacture of liquid, manufacture of tomato ketchup, beef, of, of tin of beans, of tin of peas, bottle of tomato ketchup, production of wine or soft drinks. All right. Now let us go into process costing proper. Okay. Now look at this account here, a simple process account. This is the example we will be using throughout this class. We'll be using materials. Uh, Look at conversion costs, 500 naira. Then you look at the output, 100 costing you 15. Okay, so can you see that the two accounts is balanced? The one on the left hand side and the one on the right hand side are balanced. Material have units and naira, an amount, that's value. The output also have units and value. That is why we are separating materials from conversion costs. So that we want to examine whether the material we had at the start, the quantity, is also the same quantity we will have at the end. Now, if you look at it carefully, conversion cost does not have um, units. So it means that the units of materials, we are merely converting them into the final product. All right, so it means that all the materials we had at the start entered the output. It's straightforward. Let's see another example. Now, this is the same material, the same quantity of conversion cost. Now, let me tell you, your inputs, your input processes, in the process account, your input is at the left hand side of the account, while the output is on the right hand side. So material is an input, conversion cost is an input, giving you an output and loss. Now, can you see that there is a loss of 10 naira and there is a loss of 10 units and there is a loss output of 90. But wait a minute, there is no value here for the output. You see here, in this first example, there is value for output. But now in this example, there is no value for output. But you must balance the two accounts. So you must do something. So we ask ourselves, this 1,500, where will it go? Can we at 1,500? Or are we going to share it proportionately between output? We have to make a decision. So in this kind of decision, we have to ask ourselves, Are our losses recoupable or they are not recoupable? If they are recoupable, it will help us to know how much we should put at the value for the output. If they are not recoupable, then we know that the output will be the whole output will take the whole hit when we are channel at the right hand side. Look at this example here. Same example, we have process cost. This could be a process one cost. We have materials 100, conversion cost 100. So in our left hand side is still as before. But look at the right hand side. We now have output 90. Now we no longer have loss. We now have a closing work in progress. It means that there are certain things that are not final product or not output, but they are yet to be completed to finish that process so that you get to the next process. It is yet to be completed. We call it the closing work in progress. How will you value the closing in progress? How will you value the output? So we must decide how to allocate the input costs to the good output, which is complete, and the closing work in progress, which is not complete. We're going to explain that further. Now, let's look at accounts again. In this account, there is something that is increasing the left-hand side. So the left-hand side have changed a little. We have opening work in progress from previous period. All while we have been assuming that our opening work in progress is 0, or perhaps this is the first time production is starting since the company came into existence. But now in this case, we must have done closing work in progress in the previous period, which will now become opening work in progress in the new period. Of course, whatever you value your closing work in the period is what you will value in the new period. Then we have our material and conversion costs. Now, the output and the closing work in progress is still left hanging. So we're going to see how we can deal with that. So the opening work in progress from previous period will have a basic problem to face. And to solve that problem, we either have to deal with the opening work in progress in 2 ways. Either we use the weighted average cost, weighted average method, or the first in, first out. We explain that. Now, can you see the format? The format of a process account. Let's look at the left-hand side. The opening work in progress, materials. Anything about materials, it must have units. So opening work in progress contain materials. Then there is direct material. Then there is abnormal gain. We'll come to that. Then the right-hand side, we have the good output. Then the normal loss. Then we have the abnormal loss. Then we have the good Okay, but know that it is not possible to have abnormal loss and abnormal gain in the same period. So when you see abnormal loss, you can never get abnormal gain. But it is possible that you can have normal loss and abnormal gain, or normal loss and abnormal loss. It's possible to have that too, but you cannot have two abnormals same period. All right. In all the questions, identify the losses. So you identify the output, identify the loss. You need to calculate the cost. Sorry. You need to calculate the cost of good output and the cost of losses and the cost of work in progress. Then you have to use the cost you have calculated to assign values to the good output, to the losses, and to the work in progress. Then you complete the process. So this is what we'll be doing. Identify loss and output. That means you must have input, conversion. Identify the losses and output. Calculate the cost of good input, losses and work in progress. Then use the cost you have calculated to value them. You complete the process account. So let's see how we can apply this when we talk about normal loss. Normal loss is something that happens in production, and it is also always anticipated and planned for. But losses might be normal. That's why we call it normal loss. When you anticipate a particular amount of loss and you provide for that loss, that is a normal loss. Okay, so in normal loss, look at the example we have here. The normal loss is always anticipated for. And look at the formula for normal loss. Normal loss is quantity of material input minus expected output. So let's look at an example. Normal loss. A company has normal loss as 10%. So if a company puts 5,000 liters into a process and it's expecting 10% normal loss, that means the normal loss would be 500. If a company has normal loss of 10% and it puts 5,000 liters into a process, it means the normal loss will be 500. Then what will be the expected output? The expected output will be the material input, which is 5,000 liters, minus the normal loss of 500 will give you your expected output. That means that you have 5,000 liters into a process, and you have just expected that 500 will go bad or will be lost, then it means that at the end of the day, you are expecting 4,500. So let's look at it in this example here. A person buys a liter of soup. The soup must be heated, but heating will cause evaporation. So when the soup is ready to eat, it will be less than 1 liter because some has been evaporated by normal loss. So normal loss is how much evaporation that we would normally expect. Now, there are some losses that are recoverable and those that cannot be recovered. Now, looking at the soup, when you are heating up the soup, you are getting a normal loss. Let's say you bought the liter of soup for 500 naira and the loss, the normal loss due to evaporation was 10%. That means 0.9 liters will be left of your normal soup. But since you've already paid 500 for the soup, it means that the whole 0.9 liters is what the 500 naira is what the 500 naira. Unlike the 1,000 or 1 liter of soup, which you actually paid for 500. This is because you cannot recover the normal loss. And the normal loss is something that has become part of the process. In this case, because you cannot recover that evaporated soup, you cannot do anything about it. You cannot assign cost to it. So the whole good product, 0.9 liters, is left valued with the overall cost. Now look at this formula. Cost of good output. Cost of good output is equal to total process cost divided by expected unit of output. So we'll see how we'll solve a question in a moment. Okay, so let's go into another example. Normal loss where there is no recovery. We have input quantities of 2,000 liters. Then we have a normal loss of 10%. It then means that 90% is the good output. So if you look for 90% of 2,000, it means that we are expecting 1,800 liters to come out of the operation or the process. Then when we consider the actual output, it was really 1,800. What does that tell you? It means that there is no abnormal loss, there is no abnormalities, only normal loss. And we are told that the direct material is costing you everything here is 3,006. And the direct labor cost is 300. Production overhead absorbed 600. Of course, when you add 300 to 600, you have 900 conversion cost. Now, how can you value the cost per unit of the good production? Look at the direct material on the left-hand side, 36. Direct labor on the left-hand side, 300. Production overhead on the left-hand side, 600. It means total production cost is 4,500 on the left-hand side. You must also put the same thing on the right. Now, how do you value the expected output? If you look at it, 90% is what we are expecting because 10% has gone through the normal process. So 90% of 2,000 gives you 1,800. And so when you have 1,800 liters as our expected output, and you look at the production cost of 4,500 as the cost, 4,500 divided by 1,800 or 1,800, it gives you 2 naira 50 kobo per liter. So that is how you value a good product. All right, so let us look at the process costed process account in the cost register. So in the cost register, the process cost account is a work in progress account for the process. The debit side of the account record shows direct material and direct labor and the production overhead absorbed. The credit side of the work in progress account record the cost of the finished output. The account also includes memorandum column for the quantities of direct material, input, and output, good outputs. Now, we looked at the last time when there was normal loss and there was no recoverable value. We are still following on that. Normal loss, no recovery. So you can imagine that that question we 1,000 and the material is valued at 3,600. We are also told that direct labor is 300, production overhead is 600, making everything 4,500 we had before. Going to the right hand side, we now apportion normal products. So the normal loss is 200 pieces of normal loss gone. Since we are not expecting to get a recoverable value, the 200 units out to be no value. So what happens to the output? Output will take all the blame, take everything. So what was planned before, let's say it was planned to give output 1/8 of 4,500. still be given the 4,500 because our normal loss is 0. So it means it was not recovered. So the whole burden of the 4,005 now rests on the outputs. It's not shared between the output and the normal loss. Then we can have a normal loss with a recoverable value. When we have a normal loss with a recoverable value, then the way we deal with the cost of good units is slightly different. So the formula for cost of good units will be total process cost less scrap value of the nominal loss. Expected units of output. All right, let's look at example here. Normal loss with scrap value. Okay, input quantities is 2,000 units. Normal loss is 10%. Normal loss is 10%. Expected output will therefore be 90% of 2,000, which is 1,800. And we saw that our actual output is exactly 1,800. It means 200 has been lost in the process. And we said the scrap value of normal loss. That normal loss is 200 units, or 200 liters. Each liter would cost 0.9 naira. Then we are told that our direct material cost is as usual, 3,600. Our direct labor and production overhead is 300, 600 respectively, just like old time. The only thing different between this question and the previous one is the scrap value of nominal loss. Then the cost per unit can be calculated as follows. Your direct material cost is there, left hand side. Your direct labor cost is there, and the production overhead. Everything gives you 4,500. And so you don't take the whole 4,500 like we did in the previous example and put it for the value of the good product. No, because this time around, your normal loss have a recoverable value. What is the recoverable value? We have 200 liters multiplied by 0.9, which gives you 180. That 180 from 4,500 to know how many we are going to use to value the good product. So we now have 4,320 to be used to value the good product of 1,800. And we found out that the cost per liter has dropped from 2.5 to 2.4. So the 2.5 is used to value the good product, while the 180 naira is used to value just the scrap. Okay, we will see a question in a moment. So look at the required. Look at the process accounts here. Like we said, the left-hand side contains material and conversion costs. From 2,000 units, we now go to 1,800 units. And there is a normal loss, 200, be valued at 1,008. So when you multiply units by units by the cost per output, we are going to get the value for the output. So 1,800 times 2.4 gives you 4,320. When you add it to that 120, the normal loss recoverable value, you have our total value. All right, so it means that your normal loss has a cost of disposal. That means the scrap value of 180 is the disposal cost. That is how we are going to do it. So you ask yourself each time there is a normal loss, is it recoverable? If it is, then it means the expected output will take care of the value for the scrap. But if there's not going to be expected loss, or if there is cannot be recovered, then it means that the normal loss will not have any value at the Naira stage. All right. So you see, cost of good output. The cost of good output here is your total process cost plus your disposal cost of the normal loss. So you're going to add it to your process cost and divide it by your expected units of output. So let's see another example. We have normal loss, no scrap disposal cost. Still the same example, but now the difference here is the disposal cost of normal loss. So you have a normal loss that can be disposable. Okay, look at this question. Normal input quantities is 2,000 units. Normal loss is 10%. That means expected output is 1,800 units. Actual output is 1,800 units. Look at the disposal cost of normal loss, 1 naira per unit. The cost per unit produced can be calculated as follows. Direct material cost is 36, direct labor and overhead 300 and 600 respectively. When you add these three costs, you have 4,500. Okay, now you have your disposal cost of normal loss. 200 normal losses have been made, valued at 1 naira each. It gives you 200. So that is your scrap value. When you add that to your production cost, it means that you have 4,700 expected output to result. Now, when you have an expected output of 2,000, we have 90% of 2,000 is what is being produced. It's going to give you 1,800 meters. But the final job here is to calculate the cost per liter. The cost per liter is going to be 4,800, which is 4,800, which is the, 4,700, which is the cost, less, including the disposal cost, divided by 1,800 liters. And now you see your cost has increased to 2.611. So that is the cost per liter of the food output. Now let's see how we can prepare the account here. The materials still as follows. Direct labor overhead. You don't have liters of material. They only have cost. Now the cost of disposal of normal loss, we are told is 200 from our calculation. So when you add them up together, it gives you 47. Now can you see that the whole 47 is being put on the output? Output is 4,700 because this loss, normal loss, have no recoverable value. Have no recoverable value. But now we are disposing it for 200 naira. So it has now increased our output to 2.6111. Now that's so much for normal loss. Let's look at abnormal loss. Abnormal loss is a situation whereby you experience loss that you were not expecting. So it means the normal loss is loss that you expect normally in production. And you go beyond the loss, you go beyond the expected. You now have an abnormal loss. So how can you deal with abnormal loss? Hold on a minute. Okay, so abnormal loss here is the actual loss minus expected loss. So we're going to see that in an example here. And let's look at this example. Abnormal loss is not expected and should never happen. You are not expecting to have abnormal loss. Now, this is different from normal loss. In normal loss, you were expecting it. For abnormal loss, you were not expecting it. So we are going to deal with abnormal loss as though it is part and parcel of our good production. Because if we had no abnormal loss, it will become part of our good production. So we have abnormal loss is to be treated the same way we treat our good production. So what it means is that any amount we value our good output, that is the same value we will attach to abnormal loss. It is very possible that abnormal loss will have a higher cost than the normal loss in unit rates. Okay, so let's go and see one question now to understand this process. The following information relates to product X. Now look at it here. How will you know you have enough abnormal loss? You have 2,000 units of input material. You have a 10% normal loss expected. That means your expected output is supposed to be 1,800. But lo and behold, your actual became 1,700. What went wrong? what happened to the 100 that is not accounted for? So that's the essence of taking abnormal loss as part of the good production. Okay, so abnormal loss there is 100 liters. Now, how can we calculate the cost of the per unit of each material? As before, we added our direct material, our direct labor, our production overheads. We add them together to give you 4.5. Now, 4.5 is your total production cost. What is our expected output? Our expected output is supposed to be 1,800 and not the actual output we now saw of 1,700. So because we were expecting 1,800, the 100 unit lost is assumed to be part of the expected, and so it will be valued the same way as the good output, which is 2.5 liters. So the cost of finished output is 1,700, which is input, which is the output harvested. Output harvested is 1,700 multiplied by 2.5 units and 2.5 naira, which will give you 4 naira to 250. Cost of the abnormal loss, that 100 that is abnormally lost, you will still value it at the cost of the good production, which is 2 naira 50. Then you prepare the process account in this way. The material, labor, and production overhead still as before. But now if you look at the actual output of 17, you have valued it at 2 naira 50 for each. Your abnormal loss of 100 units, you are also going to apportion it or to calculate it at 2 naira 50. It's only the normal loss that is expected not to have the scrap value because we cannot recover the loss. But if it is recoverable, then we put a value in the normal loss. So going to the double entry here, abnormal loss double entry, you debit the abnormal loss account and you credit the process account. And so if you look at the abnormal loss account here, it's coming from process cost to the debit side. That's why the abnormal loss account is debited, while in the process account it is credited. Now, when abnormal loss has recoverable value, when a loss has a scrap value, the scrap value of normal loss is deducted from the process. An abnormal loss will also have a scrap value, but it's treated differently to the scrap value of normal loss. So all these are the things I just told you here that we are also going to charge the normal loss as part of the good production because it is included in your expected units. So this is how the double entry will look like. So let's see if we have another question here to solve. Abnormal loss. Once again, this is the same question we had before. And we introduce when we want to solve abnormal loss. Now we are asked to prepare an account, process account for the information. So the process account is not difficult, also not too easy. But let's watch. The materials on the left-hand side was input materials 2,000. And look at the conversion cost. 600 plus 300, 900. Okay. Then we go to the process output. The whole expected, the actual output, is what is being recorded as output here. And how much did we value it? We value it to a value of 4,800. Then we have our normal loss. The normal loss is 200 in units, and it is 180 in value. When you get to the abnormal loss, we observe that it was 100, but it's going to be still valued by the normal output. So whatever rate we have at the November and at the output, 240, is still the same thing we're going to have at the abnormal loss, 240. So it's taken that the abnormal loss should be among part of the group proportion. So you have a statement of accounts, accounting losses, debit the account loss account to process X, then you credit the scrap account on the income statement. Now when you get to the scrap account, process X, account normal loss. Okay, so the normal loss you had in the process account, you bring them in the scrap account. Then the abnormal loss is called the abnormal cost or loss is also brought in. Now look at the scrap account, the credit side. Cash of 300 at 270. Okay, so let's go to abnormal gain. Abnormal gain, I think, is the ending of our topic for today. Abnormal gain occurs where what you actually harvested is more than what you were expecting. You don't have abnormal gain in the same line, in the same accounting line that is abnormal loss. Abnormal loss is on the left hand side, on the right hand side. Abnormal gain is on the left. Abnormal gain in the same account. Let's take one question here that have to do with abnormal gain. And let's look at the same question we'll be looking at, but now we were expecting 1/8. So lo and behold, when we went to harvest, actually, they're getting 1/850. And that means the abnormal gain from 5 units. Sorry, 50 units. Now, when you want to cost it, the material cost is 36, and the conversion cost is 900. It's 4,500 as before. But now, when we want to get the normal cost per output, we divide the expected total cost with the expected output to get 2.5. Okay. Look at it. This is the cost of finished output. Finished output. Here. Finished output is 1,850 because we have the abnormal gain, we have the output. So the output was 1,850 instead of the 1,800 that was expected. Okay, so 1,850 multiplied by the price for good output, which is 2.5 naira per liter. You multiply the two, you're having 4,625 as your output finished product. Then we also have what they call abnormal gain. So now abnormal gain always stays in the left-hand side of the account. So this is 50 units multiplied by 2 naira, which is the cost of the good item, good amount that's one part of the total expected output. Okay, but since we have no normal loss is seen to be 0. We are told to prepare an account for the information to prepare a process account. Now, your process account have your materials left-hand side as we usually know. 3,600 is the value, but now we have conversion of 900 and abnormal gain being in that same line. So abnormal gain will increase the material cost. So we have 500 naira and 500 units and 125 naira. Now we go to the output. Because there was abnormal gain, now made your output to be 1,850. Okay, then your normal loss is 200. And your normal loss have no recoverable value, and we've seen how we can recover our output with 2 naira 50 kobo. So our output is 2 naira 50 kobo. Our abnormal gain is also 2 naira 50 kobo. The same way it is being valued. All right. Now, when abnormal gain has a normal loss with recoverable value. So now it means the normal loss here has a recoverable value of 0.9 liters, 0.9 naira per liter. Mind you, in the previous example, normal loss have no recoverable value. Now it has, and it will affect how we are calculating our cost per liter. So after getting our direct material, direct labor, production overhead, we'll have to less the normal loss and this value of 180 from whatever we have calculated before. So instead of to calculate 4,005 and now deal with the abnormal loss, we are going to remove this 180 naira as the scrap value for the normal loss. So in the first example, there was no normal loss. So we have no 180 or any value to be removed, to be deducted from the 4,500. But now we do. We have normal scrap value 180, and you get your total production cost of 4,320. When we divide all these by our expected output, we are getting 2.4. So you see, it has improved 2.4. This is now the process account. Material cost, no doubt about that. Conversion cost, no doubt. But the difference here is abnormal gain is 50 naira at 1, 2, and the good output is 1,850 at 4,440. So both the output and the abnormal gain are being valued at the same amount per unit. The normal loss, the scrap value was given, and so the normal loss has been taken care of when we are calculating the costs per unit of each product. So far so good. We've learned what a process account is. We've seen normal loss, we've seen abnormal loss, we've seen abnormal gain, all having a bearing in our process costing account. So our advice that you go through this material again, look at that one example we'll be using and try to see how we recognize the normal loss with recoverable value and without recoverable value. We also try to see how abnormal loss also have a bearing. Abnormal loss is treated as part of the good production. So we value it as part of the good production. Abnormal gain is an extra from what you are expecting. It's treated as part of the good production. Thank you so much, guys. If you have any question, please send it to my WhatsApp or send it to the WhatsApp group that we created to add you to this forum. At this point now, I want to stop sharing and take a bow. I believe you're going to read this material and ask your questions as appropriate. Thank you once again. Good night.